Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Welcome back. In today's video, we'll be talking about macroeconomic global growth trends and why they can impact grain prices over time. We will look to the past to gain some insight into what the future may bring. Today's topics include why GDP, gross domestic product, is important, why worry about recessions. Trying to predict recessions is important, and then we'll also look at past examples using charts. Now, knowing the economic cycle, where we're at any point in time, is very, very important when trying to predict the direction of grain prices in the future. The global and domestic economies are in expansion mode, including Europe after the 2008-9 recession. Why is this important? Well, it basically supports higher demand for grains and commodities. Here's a good example of a chart of global GDP forecast or growth over the last decade, and you can see that in 2009 we had a mild recession. The last 10 years has provided us with about a 2.8% average growth rate around the globe, with the exception being 2009. Our second topic today includes why recessions are important to predict. In our previous chart, we looked at the global growth over many, many years, and we saw that in 2009 there was a recession. It began in 2008, and that recession provided about a minus 1.9% growth. Here's an example with 2008 December corn daily futures chart, why recessions are important to watch. Because in 2008-9, it happened in the U.S. financial crisis. It started in the U.S., and you can see by the time corn hit that peak around that $7.50 per bushel mark, within quick order, because of that recession, we destroyed demand and the price dropped to $3 a bushel. The last example using December 2008 corn futures chart is a good illustration that demand can get destroyed, as was the case in the 2008-9 U.S. financial crisis, and it slowed down global growth as well. Watching the U.S. economy is very important. It's the #1 economy in the world. The recession of 2008 actually started in the U.S. over the 2008 financial subprime mortgage crisis. The U.S. had 0% growth in 2008 and a negative 2.6% in 2009. It eventually spread around the world. The #2 biggest economy in the world is China. In fact, in 2008-09 U.S. financial recession, China kept growing. Eventually, it did slow down from the 10+%, now in that 7 to 8%. And in fact, even India kept growing nicely, and eventually that growth slowed down. Growth eventually came back, as did demand to support higher prices around the world. Our third topic today includes examples by using charts. Our first example is November 2008 soybean futures chart. And you can see from the chart that prices hit record highs of $16.36 a bushel before that U.S. 2008-09 recession destroyed demand and sent prices below $10 a bushel. A combination of better demand and tighter supplies eventually sent some grain prices up to new all-time record highs. Prime examples, the March 2012 cotton futures. Cotton futures approached $2.27 a pound, a new record high. Also, the December corn futures chart, this is 2012, went to all-time record highs of $8.49 a bushel. And again, the November soybean 2012 futures chart, prices went to all-time record highs of $17.89 per bushel. In summary, global and domestic growth are important in determining demand and is again only one of many factors that can have a large influence on commodity and grain prices in the future. Stronger global and domestic growth will create more demand and drive investor confidence and their appetite for risk up, sending grain prices higher. Remember, some years are better than others, and it's never perfect. Knowing and having some idea of the economic cycle, whether in recession or expansionary growth phase, is critical in determining the rise and fall in demand and eventually prices. We cannot plug demand into our models and project forward, but we can manage risk and volatility. Remember, keep one eye focused on economic growth trends around the world.